Good morning, and thank you, Kevin, and it's great to be back again this year. I'm going to start with a look at the macro environment, what's happened to trade, and then actually what's happening to capital. Right? And why do we look at capital? Because that tells us where trade is going to move in the future. And we see some really interesting shifts in FDI. But clearly we've moved into a new era, right? So we had the era of markets, the peak period of globalization, low tariffs, shift of manufacturing, a relatively stable world, globalization in a unipolar order. And we do see, clearly, we've moved to a new era of multipolarity, away from digitalization, moving more towards humanization and the AI interface to that humanization. We've had a demographic gift in much of the world, including China, but that's now shifting rapidly into a period of depopulation and dependency. We've had fossil-fueled growth, and we're moving into an era of electrification and some contestability about where is the future energy coming from. And we're moving from a source of cheap capital, relatively easy growth to, well, a lot of debt and kind of unclear really how long and whether that can sustain. So we've clearly shifted into a new era. And at the start of this new era, Asia is positioned very differently to how it was at the start of the previous era. So, manufacturing is now 53% Asia-based. The value added in manufacturing is predominantly in Asia. The innovation has shifted as well. Patents granted is majority in Asia. The demographics has moved. You're consuming middle-class households, the majority in Asia. Primary energy consumption, very close, right? But basically, clearly, significant shift. And I'll talk about FDI. Right? Back, if we were to look 30 years ago, very little FDI into Asia. Now, half the FDI. There have been shocks to the system. Right? Now, tariffs are not new on a longer time frame, but certainly in the period when most of us have been active, kind of tariffs are a new thing. And if we were to look, the right-hand side shows the trade restrictions imposed over time. Right? We went from an era of free trade, low trade restrictions to like 8 times the number of trade restrictions globally. And it's not just the US, it's other markets as well, some in response to it, but generally a splitting and a more multipolar world. And that affects who trades with who, and I'll spend most of the time looking at kind of who trades with who. Just quickly on the US tariffs, right, on the longer-term time frame, it's not that unusual, right? This looks at the weighted average tariffs of goods coming into the US, right? So we're well below where we were back in the 1900s, so on a long time frame. But we've all been used to this period of low tariffs, globalization, and so kind of it's a significant jump back up, and therefore a significant shock to trade, because we'd all got used to this period of low tariffs. Interestingly, the bark is slightly worse than the bite, as inevitably. So if you actually look at the weighted tariffs the US imposed, this is as of about the end of last year, it was 17.5% on imports if you weighted it across all the goods. But if you look at what was actually paid, it was only 8.7%. And that's because there were some last-minute exemptions for various things. People diversified their sourcing. They found other routes to get goods in. There's some element of price elasticity. They just switched away from goods which were higher priced. And if there have been a number of factors which has made the tariff, the actual effective tariff, probably only half what the headline number was. However, it's still very significant, right? If you're producing consumer goods and you're hit highly price elastic and you're hit with tariffs, trade does shift. And something else has changed as well. Anyone who was here last year will remember I talked about what we call geopolitical distance, right? And geopolitical distance has increased and become more important. A reminder, what do we mean by geopolitical distance? It's basically how politically aligned countries are with each other. And we do that by analyzing their voting record at the UN. And so you can kind of see, you see clusters of countries which kind of actually vote similarly to each other and therefore have a similar kind of worldview and political outlook. And they're not necessarily close to each other, right? So yes, you get the US and Europe, but there's also Japan and Korea are similarly politically aligned in terms of how they voted at the UN. And you get, on the right-hand side, China, Russia, Iran, Vietnam voting quite differently, but similarly to each other. And so and we look at something we call geopolitical distance. So we've had tariffs and we've had increasing geopolitics. So how has that actually led to trade shifting? Chart on the left looks at physical distance of trade. So if you were to look at your average goods, how far do they move? And of course, in shipping, we care a lot about this because this is our ton miles. And there was actually a gradual increase through the last few decades. Goods on average were moving further. So yes, we heard about growing regional trades, but actually the longer intercontinental trades were growing faster. And we saw the average distance of trade continue to increase. Now that's flattened over the last 10 years or so. But we also measure what we call the geopolitical distance of trade. So basically that chart I showed you a minute ago, we score everyone between 1 and 10, and kind of what is the average distance, geopolitical distance which people are trading with each other. And through the 2000s, that increased rapidly. Right? The world got comfortable trading with people who weren't necessarily aligned with them politically. And we've seen a pretty significant reversal. And that's further ticked down recently because of the tariffs and the recent geopolitical challenges. So some people call it friend sourcing, right? There's a clear evidence that people are trading more with people, with other countries who are politically aligned with them. Oh, what has shifted? So this looks at country by country, and how did the US imports shift? If it's above that dotted line in the middle, there has been an increase. If it's below, there has been a decrease. You'll see that the biggest beneficiaries has basically been Asia Pacific, excluding Japan. Right? So there's been significant imports from Taiwan, Vietnam, Thailand, Indonesia have all benefited significantly, and you see China as the big negative on the right-hand side. Europe, in general, has been hurt by it. There's a couple of outliers, and it's driven by weird things like gold and pharmaceutical front-running, so we don't, as shipping, we care less about those things. I want to get deeper into kind of China and the US in particular. How do they trade with each other, and what can they do? Right? So, complicated page, so apologies because I know it's early in the morning, but let me spend a minute to explain how to read it, and then you'll kind of see that there's some insights coming from it. Horizontal axis, what is the US share of China trade? So kind of how important is the US to China in this particular trade? Vertically, China's share of US imports. Right? So how important is China as a supplier to the US? And so you get some things like, let me take T-shirts, which is kind of somewhere in the middle, where yes, China is exporting a lot of T-shirts to the US, but so are a lot of other countries. And so kind of, yes, there's an increase in tariffs there, but your average US importer has got other choices. And you see a reconfiguration of trade happening relatively easily. And we have seen that happen. The things we worry about a bit more are the things up towards the top and towards the top right, where the countries are highly reliant on each other. Other countries don't have the capability of manufacturing in this particular area. And this is where there's either you need to either the tariffs have the biggest impact on the elasticity, or you need the biggest reconfiguration of the supply chains. The very top right is Christmas decorations and like party balloons and goods, right? China makes everything for the US, and the US imports almost all of it from China, right? So kind of look, Christmas decorations is therefore a challenged sector, and kind of does that diversify and move to other locations, or do we just see a reduction in demand in Christmas decorations? And so we've tracked these, and basically what you typically see, the things in the top right have suffered more from elasticity, and demand has gone down for them, right? When things get more expensive, consumers buy less. Just for interest, kind of the other way around, kind of what is China more reliant on the US for? There's things such as aircraft engines, and then some agri-bulks, right? So sorghum being the only thing which is really as a standout, but there's less impact in the other direction. And where did it move? Right? So this looks, the left-hand side looks at kind of which countries have declined in imports to the US across different commodities. And the purple here is China, right? So you see every single one, China has lost share. And the right-hand side looks interesting, well, where has gained share? Right? In electronics, it's been Taiwan, Vietnam, transportation, Mexico, Vietnam, Mexico, you see the same names coming up. Some of that is true shifts, some of that is kind of Chinese manufacturers being creative and setting up final assembly plants, importing into one country and then minorly processing and importing again to find alternative routes into the US. But kind of you see that it's Southeast Asia, it's Taiwan, and it's Mexico which have really gained. It's not easy for stuff to move though, right? We should always remember, like China has just developed an unbeatable manufacturing ecosystem, right? The capex of goods production, so the production lines, the engineering to produce those production lines, the employment and skills in manufacturing, the infrastructure which has been put into ports, roads, shipping, right? It's incredibly tough for a lot of this manufacturing to move, and I'll come back to this at the end. So that's what's happened so far. We're also interested in what happens next. And to do that, we look at FDI, so foreign direct investment. And why do we look at foreign direct investment? Because kind of trade follows it. And we've looked historically where there has been significant FDI investments between countries. A few years later, trade increases between those countries, as you'd expect, right? You're investing into a manufacturing plant. And so FDI has shifted towards what we call the industries of the future, right? You see which ones have increased the most. A big jump in energy, a jump in metals and minerals, and a big jump in advanced manufacturing, so chips, EVs, and so on. And the overall FDI flows have continued to increase, but 75% of the announced FDI is in these what we call future-focused industries. And there's been quite a shift in where that FDI is invested as well. FDI is broadly flat. It's slightly down. That's the blue line on here. We also look at the geopolitical distance of FDI. So, kind of, are countries willing to invest in other countries who are voting significantly differently from them in the UN and have a bigger geopolitical distance? And we see a significant fall in the geopolitical distance of FDI. Again, you can explain it, right? Look, with the increasing tensions globally, are you comfortable putting a major foreign investment into a country who might not be aligned with you? No, and we've seen FDI fall twice as fast, the geopolitical distance of FDI fall twice as fast as we've seen the geopolitical distance of trade fall. Where's it shifted from and to? So there's a very clear winner, which is the US, right? So grew well over 100%. So massive increases in FDI into the US. And kind of the negative is China, right? We saw FDI fall from China. So foreign companies are investing less into manufacturing in China, diversifying it to other areas. There's also some big numbers here for ASEAN and for the Middle East, but the US is the clear winner. So there is evidence that this idea and kind of look, the encouragement to make in the US is leading to FDI shifting to the US. And we can split it out by industries, and I'm going to just show you two of them. This is semiconductors. Right? And for shipping, we don't care too much about semiconductors because they're small and light, but value-wise, there's a lot of money in this. So, and you just see the dramatic picture. The left-hand side is what happened in the last decade. The right-hand side is what's happened so far this decade. Right? And previously, the US was a net investor overseas of FDI. And you see that mainland China was actually kind of a big recipient of FDI. There was lots of semiconductor foreign investment going into China. What do you see now? China remains small, but there's a very significant, large recipient of FDI investment, which is the US. And look, a significant amount of this is one deal, right? The TSMC investment, which has been decreased slightly, but is still going ahead at some scale between Taiwan and the US. So basically, the countries which previously were investing into China, so a lot of the chip technology is in Taiwan, is in Korea, now investing into the US. And the same one in EVs and batteries, right? So previously, mainland China was a big recipient. Again, now you see the largest recipient of foreign direct investment is the US. So there's been a pretty significant shift, right, with the changes in the geopolitical environment, the introduction of tariffs, and moving towards a multipolar world. So what's happening? So first of all, we see trade follow FDI. So we would expect to see some trade shifts because of this. Trade is obviously slower to move and happens over time, but we would expect to see some shifts in manufacturing. And depending on which of our colleagues at the McKinsey Global Institute have modeled out some scenarios, they think that sort of up to 30% of trade is contestable, like depending on how you see the future FDI flows develop. Countries need to worry about their own competitiveness. Right? There's now real competition between countries to receive these mega FDI deals. The deals are bigger than ever, so the dynamics of and they're all spurred by multinational companies. And so we see multinational companies increasingly interested in the geopolitics, needing to understand the longer viability of their investments. And it shifts the ecosystems, right? As everybody's moving the foreign investment, like the related industries, whether it's manufacturing equipment, whether it's construction, whether it's labor provision, also shift as well. So as foreign direct investment moves, we see the business ecosystems around them also shift. If I was to leave you with one final thought, look, all this does look, it does look a bit more negative for the outlook for China, right? There's less FDI, there's more trading with each other. But kind of look, even if you cut the growth rate of China, right? And China has just met its export targets, as I'm sure you all saw. If China continues to meet its GDP targets, that's the dark red, right? It's still by far the largest increase of anywhere globally. But even if China were to stumble and only achieve 2%, which is lower than it has for the past several decades, that increase in GDP is still larger than any of these other countries. Right? So even if China falls to a lower growth rate, the absolute amount of growth in China is larger than India, is larger than ASEAN, is larger than other regions. So even if China does slow a bit, the next China is still China. So there continues to be significant growth in GDP, in manufacturing, and therefore in trade. I know there's a lot to take in. This is a quick recap of a few different reports which my colleagues at the McKinsey Global Institute have developed. There's reports on trade patterns, how trade shifts, and FDI. I've shown you highlights. If this is the kind of thing which excites you, take a picture of this, and these QR codes will take you to fuller reports. And I'll put this on the website afterwards, so you can all look a bit further and deeper. Hope that wasn't too heavy. I know there was lots of data and charts for early in the morning, but I look forward to the panel's discussion on similar topics. Thank you.